Momentum indicators are technical analysis tools that measure the rate of change in price movements of financial assets. They help traders identify the strength or weakness of a trend by comparing current prices to past prices over a specific time period. These indicators transform raw price data into oscillators that show momentum. Let's see how a momentum indicator responds to these price movements. As you can see, when prices trend upward strongly, momentum rises into the overbought region. When prices fall sharply, momentum drops into the oversold region. Momentum indicators are essential for determining whether a trend is likely to continue or reverse, providing valuable insights for timing market entries and exits. Momentum is a fundamental concept in financial markets that describes the tendency of price movements to persist in the same direction. At its core, momentum suggests that assets which have performed well in the recent past are likely to continue performing well in the near future. This principle forms the basis of momentum trading strategies across various timeframes and markets. In bullish momentum, prices tend to accelerate upward, creating a self-reinforcing effect as more traders recognize and act on the trend. Conversely, bearish momentum shows prices falling at an increasing rate, often signaling continued downward pressure. Momentum traders follow several key principles that guide their decision-making process. Understanding momentum helps traders in several practical ways. Perhaps most importantly, momentum indicators turn subjective market observations into objective measurements that traders can rely on for consistent decision-making. By quantifying momentum, traders can develop systematic approaches to capitalize on market trends while managing risk. The Relative Strength Index, or RSI, is one of the most popular momentum indicators in technical analysis. Developed by J. Wells Wilder, it measures the speed and magnitude of recent price changes. RSI is measured on a scale from 0 to 100. This range is divided into key zones that signal different market conditions. RSI readings below 30 typically indicate oversold conditions, suggesting a potential upward reversal. Values above 70 indicate overbought conditions, suggesting a potential downward reversal. The RSI is calculated using a relatively simple formula. It's based on the ratio of average gains to average losses over a specified period, typically 14 periods. To understand how RSI works in practice, let's examine a price chart with its corresponding RSI indicator. As prices rise and fall, notice how the RSI indicator reacts. When prices make strong upward movements, RSI rises toward the overbought zone. When prices decline, RSI falls toward the oversold zone. RSI generates trading signals at key levels. When RSI moves from below 30 to above 30, it creates a bullish signal. When RSI moves from above 70 to below 70, it creates a bearish signal. Let's summarize the key points about RSI. It traditionally uses a 14-period calculation, with thresholds at 70 and 30 marking overbought and oversold conditions. The center line at 50 can indicate the overall trend direction. While RSI performs best in ranging markets, traders can customize the period settings between 5 and 25 periods depending on their trading style and time frame. The stochastic oscillator is a momentum indicator that compares a security's closing price to its price range over a specific time period. The stochastic consists of two lines, cent K and cent D. The cent K line calculates where the current closing price sits relative to the highest high and lowest low over a given period, typically 14 days. The cent D line is simply a 3-period simple moving average of the cent K line, which acts as a signal line. Both components are typically calculated over a 14-day period, though this parameter can be adjusted based on trading preferences. Let's look at how the stochastic oscillator works with a ranging market example. Below our price chart, we can see the stochastic oscillator with its two components. The stochastic oscillator operates on a scale from 0 to 100. Readings above 80 indicate overbought conditions, shown here in red, while readings below 20 suggest oversold conditions, highlighted in green. The main line, cent K in green, shows the current value of the oscillator. The signal line, cent D in gold, is a 3-period moving average of cent K. The stochastic oscillator is particularly effective at identifying potential reversal points in ranging markets. Traders look for crossovers between the cent K and cent D lines, especially when they occur in the overbought or oversold zones. Divergence between price and the oscillator can also indicate potential reversals. Unlike some momentum indicators, the stochastic oscillator performs best in ranging or sideways markets, rather than trending ones. The key strength of the stochastic oscillator is its ability to identify potential reversal points, helping traders time their entries and exits in ranging market conditions. The Ichimoku cloud system is a comprehensive indicator that provides information about support, resistance, momentum, and trend direction. To understand the momentum components of the Ichimoku cloud, let's first look at a sample price chart. The Chico span, also known as the lagging span, is a key momentum component of the Ichimoku cloud system. The Chico span is calculated by taking the current closing price and shifting it back by 26 periods on the chart. When the Chico span crosses above the price line, it indicates bullish momentum. This means the current price is higher than it was 26 periods ago. Conversely, when the Chico span crosses below the price line, it signals bearish momentum. This indicates the current price is lower than it was 26 periods ago. The Ichimoku cloud system includes other components that work together with the Chico span. These include the Tenkan Sen, which is a 9-period moving average, and the Kijun Sen, a 26-period moving average. The relationship between the Chico span and these other components provides comprehensive momentum insights. For example, when price and Chico span are both above the Kijun Sen, it confirms strong bullish momentum. Here we can see strong bullish momentum when both price and Chico span are above the Kijun Sen. Conversely, strong bearish momentum occurs when both are below the Kijun Sen. To summarize the Ichimoku cloud momentum components, the Chico span crossing above price indicates bullish momentum. The Chico span crossing below price signals bearish momentum. And for the most reliable signals, use the Chico span in conjunction with other Ichimoku components. Let's examine the Chande Momentum Oscillator, an important tool for measuring momentum in financial markets. The Chande Momentum Oscillator, or CMO, was developed by Tushar Chande, a prominent figure in technical analysis. The CMO uniquely measures momentum by considering both up days and down days in the market. The formula calculates the difference between the sum of recent gains and losses, then divides by the total price movement. Let's break down the components of the CMO formula. It uses the sum of all price gains over a period, typically 14 days, and the sum of all price losses over the same period. The CMO ranges from -100 to +100. This gives traders a clear perspective on momentum strength and direction. The indicator is divided into 3 main zones. Readings below -50 indicate oversold conditions. The middle range between -50 and +50 is considered neutral. Readings above +50 suggest overbought conditions, which may indicate a potential reversal. Let's look at how the CMO appears in a practical trading scenario. Here we have a price chart of a financial instrument. Below is the corresponding Chande momentum oscillator with a period of 14. The CMO fluctuates between -100 and +100, with the zero line representing neutral momentum. The key levels to watch are +50 and -50. When the CMO moves above +50, it indicates overbought conditions. Similarly, when the CMO falls below -50, it suggests oversold conditions, which may present buying opportunities. The CMO provides several actionable trading signals. When the CMO rises above +50, it signals overbought conditions. Traders might consider reducing long positions or preparing for a potential reversal. When the CMO falls below -50, it indicates oversold conditions. This might present buying opportunities or suggest covering short positions. The zero-line crossover is another significant signal. An upward cross suggests increasing bullish momentum, while a downward cross indicates growing bearish pressure. The Chande momentum oscillator offers several key advantages compared to other momentum indicators. It measures both up and down momentum, providing a more complete picture of market dynamics. The CMO is also generally less volatile than other oscillators, with clear overbought and oversold boundaries at plus and minus 50. The indicator is particularly effective at identifying price extremes and can be applied across different timeframes to suit various trading strategies. The ultimate oscillator was developed by Larry Williams to address the problem of false divergences in other momentum indicators. Unlike many other oscillators, it takes a unique multi-timeframe approach by combining short, intermediate, and long-term price action into a single indicator. The oscillator measures buying pressure relative to true range across these different timeframes, resulting in a value that ranges from 0 to 100. Readings above 70 indicate overbought conditions, suggesting a potential reversal to the downside, while readings below 30 suggest oversold conditions, indicating a possible upward reversal. By observing how the ultimate oscillator behaves in relation to these levels, traders can identify potential buy and sell signals. The key benefit of the ultimate oscillator is that its multi-timeframe approach makes it less susceptible to false signals during strong trends. Notice how the oscillator identifies overbought conditions here, followed by a price decline. And here we can see an oversold condition that precedes a price recovery. By incorporating multiple timeframes, the ultimate oscillator provides a more balanced view of market momentum, helping traders make more informed decisions. Momentum divergences occur when price movement and indicator readings move in opposite directions. A bullish divergence occurs when price makes a lower low, but the momentum indicator makes a higher low. This suggests weakening downward momentum and often signals a potential upward reversal. A bearish divergence occurs when price makes a higher high, but the momentum indicator makes a lower high. This suggests weakening upward momentum and often signals a potential downward reversal. Divergences are powerful signals that often precede significant price reversals. They're most reliable in ranging markets, especially when confirmed by other indicators. The signal tends to be stronger in overbought or oversold conditions and on higher time frames. Momentum indicators behave differently depending on market conditions. Let's examine how they perform in trending versus ranging markets. In a trending market, price moves consistently in one direction with occasional pullbacks. While in a ranging market, price oscillates between support and resistance levels without a clear directional bias. Let's examine how the Relative Strength Index, or RSI, behaves in each market condition. In trending markets, RSI can remain in overbought territory for extended periods during uptrends or oversold during downtrends. This can lead to false reversal signals, as the indicator suggests the market is overextended while the trend continues. In contrast, during ranging markets, RSI oscillates more regularly between overbought and oversold levels. This provides traders with more reliable signals for entry and exit points. To maximize your success, select indicators that match the current market condition. In trending markets, trend-following indicators like MACD and ADX often perform better. While in ranging markets, oscillators like RSI and stochastic typically provide more valuable signals. The key takeaway is that understanding market context is crucial for correctly interpreting momentum indicators. The time frame used when calculating momentum indicators significantly impacts their signals and reliability. Let's examine how different time frames affect RSI signals using the same price data with 3 different calculation periods. A shorter time frame, like this 7-day RSI, is more sensitive to price changes. It generates more signals as it crosses overbought and oversold levels more frequently. These frequent signals can lead to more trading opportunities, but also result in more false positives, which can be costly. The standard 14-day RSI provides a balance between signal frequency and reliability. A longer time frame, like this 21-day RSI, is less sensitive to short-term price fluctuations, generating fewer but potentially more reliable signals. However, longer time frames may miss shorter-term opportunities as they smooth out price action. Many experienced traders use a multi-timeframe approach, analyzing momentum indicators across different timeframes. When signals align across multiple timeframes, they create stronger confirmation and identify high-probability trading opportunities. To summarize the key timeframe considerations for momentum indicators, shorter timeframes provide more signals with higher sensitivity, but also produce more false positives. Longer timeframes offer fewer but potentially more reliable signals, though they may miss shorter-term opportunities. Multi-timeframe analysis helps confirm signals and identifies stronger trading opportunities when indicators align. Finally, it's important to match your timeframe selection to your trading style and time horizon.